Hi everyone, and welcome to another FFT webinar where we're going to go over everything you need to know to put in any last minute tax plans for 25-26, which ends on 5th of April, and also to help you prepare for any changes coming in the new tax year. Remember, if you'd like to ask a question, there's a Q&A box at the bottom of the screen, and we'll have a look at some of those at the end. If you've got any more complex questions, feel free to reach out after the webinar. So it'll be myself and Adam, we're both directors here at FFT. We'll be running through the webinar today. And the plan is to cover the following topics. So in year-end tax planning and why we think it's important, the tax reliefs and allowances you could still claim in the current tax year, and those you might wish to plan for the tax year that's going to start. And then a recap of some of the key changes to taxation coming in 26-27, a lot of them originating from the autumn budget in October. So we'll pick up those points as we go through, and then we'll cover what you should do next. So why plan for the year end? If you don't, you could leave money on the table or face unnecessary stress. So you need to plan and prepare. It maximizes your tax efficiency. Each tax year offers valuable allowances and reliefs, capital allowances, pension contributions, capital gains tax annual exemption. And if you don't use a lot of them, you lose them when the tax year resets. You avoid last minute stress. So leaving everything to the last minute obviously often leads to rushed decisions, unnecessary tax bills, or worse, missed deadlines. By planning now, you ensure everything's in order, you reduce stress for you and also to us as accountants. Not that many people care about that. Also, you make the most of financial opportunities, so it's an ideal time to consider capital expenditure or other investments. Purchasing assets now could allow you to benefit from available allowances earlier rather than delaying for a further year. It also helps with your cash flow, so controlling and knowing your tax liabilities ahead of time um, makes you be able to plan for that and creates more sustainable growth opportunities. And also having less tax to pay obviously increases your cash flow. Staying compliant, given that tax laws are complex and there are deadlines that need to be met. Poor preparation leads to mistakes, penalties. A lot of these have actually recently doubled, and also potentially unwanted attention from HMRC. Proper planning helps us keep you fully compliant and allows us to explore some of those grey areas. Adam, have you got a horror story maybe you want to share about not planning properly without naming names, obviously?
Okay, yeah. We had a couple came to us a couple of years ago with a number of rental properties. They were all in one of the partners' names, actually in the husband's name, and he was an additional rate taxpayer who was a high earner, whilst his wife, his partner, had virtually no income. They never thought of questioning their setup, which resulted in the additional rate taxpayer having all the rental income. So we managed to work with them and over 2 years move things around, filing the relevant forms with HMRC and solicitors where required. And as a result, the annual income tax saving was over £8,000. They'd been doing it wrong for over a decade, and now hopefully for the next decade and more, they will be uh, receiving those annual savings. A bit of planning really can help.
Good story, good example. So we're going to go through two checklists. Initially, we're going to go through personal tax planning and then also business tax planning. It's going to cover a lot of points, but try and stay focused because there may well be one that saves you some tax. And again, if you want more detailed advice, please get in contact separately. Also, I think I want to make the point that you need to be careful and take proper advice because if you do some of these things incorrectly, it can actually make things worse. So I think before we really get into the detail here, it's important that we have a bit of a caveat because some of this stuff might be moving into the field where a financial advisor will be more appropriate to be spoken to. So in certain circumstances here, you need to consider speaking to an IFA. Okay, so let's start off. The first point here is income tax. It's very much the basics here. A lot of personal tax planning is focused on getting your income into the right tax band because moving around these obviously can make a big difference to your effective tax rate. The main bands are we've got the basic, so we've got the personal allowance, which goes up to £12,570. Obviously, there's no tax there. That's currently frozen to 2031, something none of us should be particularly happy about. And then after that, you've got your basic rate band, so that's going up to sort of 50,000 level. And a lot of people do choose to manage their income around here, keeping their sort of dividends below that threshold. It's pretty tax efficient at the moment with an 8.75% tax rate on those dividends. Um, you've got to think about things whether income can be pushed out or spread into the following year. Although this does apply to all the bands, you can do things like pension contributions and gift aid, which we'll cover in a bit more detail later. Then you've got the 100,000 bracket. This is where the personal allowance starts being lost, and you actually, for the next 25,000, you have an effective tax rate of 60%, so very punitive. A very simple example here is if you've got flexible income in terms of you can dictate what your income level is in a tax year, it can be more efficient to have earnings of 100,000 in one year and 150,000 in the next year as opposed to 125,000 each year. On a simple case here, current tax rates, you'd save about £1,000 of tax over that period. So, a little tweak there that will make no difference in practice, but can save some tax. And then you've got the additional rate threshold at 125,000. One common example we bring up here is for a family with children where over 100,000, if you exceed it by £1, all your childcare support's withdrawn, both the tax-free childcare hours and the entitlement to tax-free childcare. And that means that you can lose thousands of pounds for an extra £1 of income. So definitely something that needs thinking about and managing in certain cases. There's been a couple of changes in the budget. So the budget in October, one of them was that the dividend tax rates are going to change from April 26. The ordinary rate is going up, so that's the 8.75, that's going up to 10.75%, and the upper rate will increase to 35.75%. There's no change to the additional rate. We've actually done a review of this recently, and in most cases, we still expect that common setup with £12,500 of salary and the rest being dividends to be to still remain being the most efficient for an owner-managed business in a lot of cases. We will cover this on a client-by-client basis where we identify it's relevant in the coming months. The other change impacting income tax that's worth a note here is the rental income increase. Again, that's gone up. The basic level will now be 22%, and for higher rate payers, 42%. Again, a further attack on landlord and buy-to-let owners, of which there have been a number over recent years. With this additional tax, a lot of landlords are now selling up or moving their properties to limited companies. So yeah, something for some to think about. Moving on to pension contributions. So this is a classic tax saving opportunity, albeit again, the government's got this one under a bit of attack as well. So the 26-27 tax year, the annual allowance is going to be £60,000, and same for 2025-26. So you can pay up to 100% of your earnings into this, or if you don't pay tax, if you don't have the income, you can pay up to £2,880 and receive the tax relief. If you pay more than the 60,000, then you can be subject to a tax charge. You can also carry forward unused allowance from the previous 3 tax years and get relief on this. So something that needs to be managed if you have the opportunity to put a big contribution into your scheme. And also you actually have to be a member of a registered scheme in those tax years to be able to make a payment. So that's an important administrative point to be aware of. Another point is that a higher earner could have their annual allowance reduce. So if you think you've earned more than 260,000 in a tax year or more than 240,000 in any of the 3 previous tax years, the allowance starts tapering down. So something to take advice on. Gift aid donations. Are you claiming higher additional rate relief on your UK donations? So if you pay tax above the basic rate, you can claim extra relief through your self-assessment. In fact, some people who wouldn't otherwise need to complete a self-assessment tax return for this reason only, because there's some decent tax savings to make. or tax refunds even. As noted, you can reduce your adjusted net income below a certain rate for loss of personal allowance by making these donations. Um, Also, a point to note is it's UK charities only. An example would be if you look at a donation of £1,000, the total value of that donation to the charity is 1,250, and the individual at a 40% rate can claim back £250. 45% taxpayer could claim back £312. So it's a significant saving. There's also a useful little trick here where you can elect a gift made in the previous year, in the current year, to be pushed back into the previous tax year and used against your income in that year. So that's a useful one, and you can do that up until the 31st of January following a tax year. So it's a rare opportunity to make an adjustment to your tax after the tax year's ended. It's a good opportunity also where, in the example I gave above, someone's got this sort of cliff where they earn 100,000 and £7. If you make a £10 donation to charity after the tax year end, you can carry it back and drop back below that 100,000 and make a decent saving and improve your quality of life. Um, Interspouse transfers. So this is a really big one because there's real opportunities here. You can basically transfer various assets to your spouse without tax consequences. Um, and that can help maximize your allowances. So you can each utilize your £3,000 capital gains allowance. You can maximize your inheritance tax bands and generally reduce your income tax liability. Also, if you move things like shares around. So it's an opportunity where a couple has uneven income. If one is a basic rate payer and the other is a higher rate payer, transferring shares and then giving dividends to the spouse, who's the basic rate payer, can mean that they're paying tax on some of the income at 8.75%, where you would have paid at 33.75%. So it can be a significant saving. Other things to consider here are business property relief. So there's been a lot of press about this. The government initially put a £2.5 million cap on this for sort of a family business, and this has actually been increased to 5 million. But you can share this between spouses if the right transfers are put into place. If you do have a business where you feel that the value is more than 5 million, you do want to be planning for this carefully to make sure that unnecessary inheritance tax isn't being paid. You can also do things like declarations of trust to easily split out assets. It's a simple document you can put in place declaring a proportion as being gifted to your spouse. An administrative point here is that they need to be registered with HMRC to make sure that there's good proof that they exist. Marriage allowance is a fairly small relief, so you can transfer £1,260 of your personal allowance to your husband, wife, or civil partner, and you could save, a couple £100 in tax. You can also do this backdated up to 4 years, so you can get maybe £1,000 over 4 years. Directors' loans. So if you've got a director's loan in credit, i.e. the company owes you money, you can potentially charge a commercial rate of interest on that, and you can utilize your interest allowance. So that'd be £1,000 for a basic rate payer, £500 for a high rate payer. And so there's a little tax saving to make there. The company would be paying interest, so they get corporation tax saving on that interest. You do have to pay withholding tax to HMRC using a CT61 form after you've made that payment or in the quarter at the end of the quarter where that interest has been paid. On the reverse side, if you've got an overdrawn director's loan account, so you owe the company money, a lot of directors mistakenly assume that the date they're making the drawings is the date any related dividend must be declared. That's not true. There's flexibility and opportunity for planning here. The timing of the dividend can be managed, so you can reduce tax by spreading those dividend declarations over 2 or 3 tax years. If there's an opportunity, if the income maybe fluctuates up and down, or there's a one-off large cash withdrawal, then you can try and spread that over a few years, and you can make significant tax savings that way. It's something we quite commonly help our clients with. It's a scenario that does come up. Company cars. So switching to an electric vehicle has been popular for quite a few years now. If it's a company car, it can significantly lower benefit in kind tax. You can also claim other costs through the business, insurance, repairs, also installation of a charging point at home. It needs careful thought, case by case. The attractiveness is diminishing over time, but I think it's still present. So the benefit in kind rate for this year has been 3%. It's rising to 4% in the year coming, and it will gradually increase to 9% in 2030. So it's quite a big increase from the 1% it was a couple of years ago. Also, if you, instead of leasing, if you buy it outright, you can claim first year capital allowances on effectively a zero emission electric vehicle and the charging equipment, so you can get a big upfront tax saving. There's also there was an autumn budget update here, a little bit of the government trying to get more money out of EVs that they're losing from the petrol and diesel vehicles. So there's a new road tax of between 190 and 600 pounds, which is going to be affecting most vehicles. And also from April 28, they announced a new electric vehicle excise duty. So it's a per mile charge for electric and hybrid, or plug-in hybrid, and it will be 3p per mile. So basically £150 for every 5,000 miles, and it's half that for a hybrid, so £75. The numbers are changing fast here. Adam, do you still see this as a no-brainer for clients, or are you feeling more cautious now?
I think for most clients, when they can charge the EV cheaply at home, and especially if they're in the 40% tax bracket, then the benefit in kind saving through a company car is still significantly better. Potentially, if you're a basic rate taxpayer, so the tax only paying tax at 20%, and you're not charging at home, you're using public chargers and that sort of thing, or you're not buying a brand new EV, which comes with enhanced tax savings for the company, then perhaps the company tax benefits and the overall picture is not as clear. But if you can charge it cheaply at home and you're saving at the higher rate, it's still the best option for those who are interested in the tax savings associated with an EV car.
Yeah, so I suppose the point is it certainly shouldn't be ruled out at this point. In a lot of cases, it will still be advantageous. Just needs a bit more thought maybe than it did a few years ago. Picking up on the last point on the slide here, the child benefit threshold. So this is where people are eligible, parents obviously. So if your income is over 60,000, those payments are reduced, and they disappear entirely once your income exceeds 80,000. I think you get something like up to £1,000 a child. I think it changes between first and second child. But people need to think about this, because if you've got several children and you've got some control over where your income falls or is going to fall, then it can be worth several £1,000s a year. So it is well worth thinking about. You've got opportunities like pension contributions and charitable donations to help reduce your net taxable income and maybe bring you within that threshold. Right, so inheritance tax, so particularly gifts on these. So the October 24 budget made it very talked about for several reasons, mainly because pension assets are being brought into inheritance tax from April 27. So those unused pension funds won't be outside of the estate anymore. And that fundamentally changes things. It changes retirement planning. Pensions have been the go-to IHT shelter for a long, long time, and that's unwinding. It's not as attractive as it was. So people are really thinking about it. So you do need to think about inheritance tax and particularly gifts and what can be done there to reduce that estate. So simply, you've got a £3,000 annual gift exemption you can make to slowly reduce your estate. And also, it should be noted, it can be carried forward a year. So You could actually, if you haven't done it the year before, you could actually make 6,000 and mop up both years in one transaction. And then you have things like little gifts, so you can gift up to £250 to a recipient per tax year. That will be exempt. And there's also £5,000 on marriage from a parent and £2,500 from a grandparent as well to their grandchild. Um, Another one that's popular and very useful actually is gifts from regular income. So this is where you've got a regular income coming in. There's a surplus amount. So let's say you're earning £100,000 net, but you only need 60,000 to live off. Then you can potentially gift 40,000 on a sort of rate. You could do it monthly or quarterly on a regular basis, and that would then fall outside your estate. You won't be worrying about the whole 7 year clock. Um, and so that's very useful in that circumstance. And then the key is basically documenting a pattern, evidencing that your standard of living as the donor isn't impacted, maybe a letter of intent and a schedule signed annually. And that's quite popular and useful. Um, did I think I skipped most of that slide. I'm going to go back. Yeah, so we've got discretionary trusts. So we're not discussing new ones here, really existing ones. These are less popular in the past sort of 10 years or so, really, because there's been a lot of new charges that have come in. But with existing ones, where we have the trustee has discretion to decide how and when to distribute trust assets and income to beneficiaries, and therefore they're thinking about the timing of distributions. Um, and the relevance here is that a discretionary trust themselves are generally taxed on their own income at the additional rate of tax, so 45% on investment income, 39.35 on dividend income. And dividends made to beneficiaries are treated as being made net of this. So, for example, investment income, a trustee distributes cash of 5,500 to a beneficiary, which is effectively 10,000 net of the 4,500 tax deducted from it. But beneficiaries themselves are often in a position to receive a tax repayment on these distributions because they themselves are not additional taxpayers. So they might be a basic rate payer and they can effectively claim the difference back between the 45% and the 20%. So it's quite valuable in the £10,000 scenario, that'll be £2,500. And trustees can therefore think carefully about who they're giving to, how much they're giving, based on what they might be able to claim back. You've got your annual capital gains allowance as well, so that's £3,000. It resets at the end of the tax year, but obviously you can't always control your use of it because you don't have something to dispose of, and it's not really as valuable as it once was, but it's worth thinking about. There's one or two things you can do to try and utilize this or generally maximize your capital gains position. Something called bed and breakfasting was once very popular. So that's where you sold investments right at the year end, used up your capital gains exemptions, maximize your capital gains position, and then buy them back immediately after the year end. That's not allowed anymore. But you can have other similar scenarios where you could get the benefit. So there's something called bed and ISA. So that's if you sell funds and then buy them back into an ISA. The shares in the ISA are free of income tax and CGT. So, for example, an investor holds 20,000 of funds, and those funds are sitting or they're pregnant with an £8,000 gain. They sell and then immediately repurchase them inside their ISA using their £20,000 allowance. The first 3,000 will be sheltered, and then all future growth and income is permanently sheltered. So that sort of thing can be appealing. You've got something called bed and spouse, not as exciting as it sounds. This is where the shares are sold by an individual and bought back in the name of their spouse. The disposal of the shares crystallizes the gain and allows the individual to make use of the capital gains allowance. And you can buy back straight away because it's in the spouse's name. You can also just generally you can crystallize existing losses in a portfolio. So you might have a portfolio where some of the investments contain gains and some of them have losses. You can sell your loss-making positions and your gain positions at the same time to offset the gains, or you can just sell the loss-making positions to crystallize those losses and carry them forward against future gains. Moving on to ISAs, as noted above, you have a £20,000 ISA allowance where you can potentially shelter savings and investments from tax. There's a choice of a stocks and shares ISA or a cash ISA, depending on preference. Note that from April 27, the government has brought in an ISA cash limit, so that's going to fall from 20 to 12,000 under 65s. But there'll be also an overall annual limit, so the remaining 8,000 can be used in stocks and shares. And of course, those investments will be exempt from capital gains and also income tax. The UK also does have plans to introduce a British ISA. We don't know exactly when, and that's going to allow actually investors to put an additional 5,000 a year tax-free into UK assets. So it encourages investment in the UK, and obviously useful for us as individuals to be able to have another 5,000 a year of tax-free investment. And obviously, the reason why it's important to do it now is that it's a use it or lose it allowance, and you can't carry forward. So, there are decisions potentially to make before 5th of April. Okay, let's now move on to the next slide. So this is one I like to talk about because clients come along and they might have some excess income, and they don't know what to do with it. They want to reduce their tax. So this is something that in some cases can be appealing. So we've got SEIS, EIS, and VCT investments, and they offer significant tax advantages. So for the SEIS scheme, you get up to 50% income tax relief on up to £200,000. So if you invest 50,000, you get 25,000 of tax relief. So it's significant. At the time you invest, you also get capital gains exemption on gains and loss relief on failed investments. For EIS, you get 30% income tax relief, capital gains tax deferral, and also loss relief. And for VCT, venture capital trusts, you get 30%, which by the way is reducing from April 26 to 20%. And there's also tax-free dividends and capital gains exemption on disposal. These can be very useful if you have a high tax bill. Something to note is that EIS and SEIS have a carryback, so you can this is again one of those rare circumstances where you can retrospectively reduce tax to the immediate tax year preceding your investment. So you can invest 50,000 in EIS in 25, 26 or 26, 27. You can carry back to the previous tax year and receive 15,000 off your last tax bill. So that can be appealing. Also, something that's quite interesting to analyze is the loss relief. So, for example, for an SEIS, a 45% taxpayer might invest £10,000, and they would only lose 2,750 in real terms because you've got your initial saving and then further loss relief. So you're not really risking as much as it looks like you're risking. So that's appealing. And EIS is similar. You only effectively can lose a max of 36 pence in every pound after income relief and loss relief. So if you're risk averse, these aren't quite as risky as they sound. But having said that, I will point out that they are risky. They're typically very risky investments, which is why there's so much incentive on it. It's the government encouraging entrepreneurs to set up new business and encouraging investment into those. So, a lot of these don't work out. I'm going to let Adam take over and move through the business tax planning side of things.
Thank you, Sam. So now let's look at business tax. So the goal of the checklist we're going to work through in the next couple of slides is really to get you thinking. So as we go through the slides, perhaps take note of anything where you're unsure or you just haven't started to think about it yet. So the first thing we're going to cover is dividend taxation. Have you made use of the 0% dividend tax band of £500? it's possible for you to split dividends over the end of the current tax year, where we've just got just under a month to go, and the start of the new tax year, thereby possibly avoiding higher rate of tax in one year than absolutely necessary. Are you balancing your dividend with regular pay to create an effective and tax efficient remuneration strategy? Traditionally, a low salary and high dividends was the preferred route for many of our owner-managed clients, owner-managed business clients. But now, with high corporation tax rates, certain circumstances, such as, for example, a company paying marginal rate corporation tax, which has an effective rate of 26.5%, perhaps the director or the employee having reached state pension age, so there's no employees in iCharge, really does mean it's worthwhile revisiting the salary dividend split. As you know, directors and employees pay income tax through PAYE on their salaries, and dividends are then taxed separately under different rules. As Sam mentioned before, income tax thresholds for employees and self-employed frozen until 2031, as was announced in the autumn budget in October 2025. The budget also announced that dividend tax rates will increase and thereby further reduce the tax advantage that they traditionally offered to directors. So from April 2026, as I say, just under a month's time, the ordinary tax rate on dividends will increase from 8.75% by 2% to 10.75%. The upper tax rate rises from 33.75 to 35.75, again by 2%. The additional rate doesn't increase, it remains at 39.35%, and the tax-free dividend allowance remains at £500. So taken in as a whole, you may need to review whether a different mix of salary and dividends is now more effective, and if so, how that may affect your cash flow. It can be a really by case decision, but for most owner-managed businesses, as Sam said before, the mix of a base salary of £12,570 and dividends topping that up is still the cheapest option from a tax perspective. However, the changes in taxes on dividends means that a typical director on a salary of 12,570 and dividends of 37,700, taking them up to the top of the basic rate band and just below the higher rate tax band, will now be paying an additional £744 in dividend taxation. So that's coming round the corner, and it's going to affect business owners. So next point, incorporation. If you're a sole trader, partnership, LLP, have you considered recently whether incorporation as a limited company will offer you a more tax efficient structure for your business? There's obviously other considerations, limitation of liability, etc. But have you just thought about the tax efficiency in your business structure? Something to think about. It might be you can move swiftly on and not make any changes, but worth thinking about. Corporation tax. Do you know your corporation tax based on your profit levels? We know corporation tax is 19% for companies with profit below 50,000. It's 25% for companies with profit above 250,000. And if you fall in between those thresholds, that's where the marginal rate applies. And the marginal rate can be 26.5%. Do you realize the impact of associated companies on your corporation tax rates? If you are in control of a number of companies, it's quite possible that the thresholds are reduced and you start paying higher rates of tax earlier than you might assume. Are you carrying over losses to the new tax year, which could reduce your overall tax liability next year? And have you considered ways to reduce your profits, such as making pension contributions from the company or funding the purchase of a company car, all things we've touched on earlier. Charitable donations and bonuses. Has the company made any charitable donations? Have you as an individual made any charitable donations? And if so, have they been done in a tax efficient way, as Sam mentioned before? Gift aid personally or company donations? Tax relief on company donations is only recognised in the period that the donations were paid, whilst, as Sam mentioned before, there's a bit of flexibility on personal donations. Are you thinking about employee bonuses? And if so, have you considered the most tax efficient way to structure them, which could reduce your overall tax and national insurance cost. Things to think about there would be a salary sacrifice scheme or an employer pension contribution could be a better option than giving a pure cash bonus to your employee. Capital allowances, again, has the company purchased any assets before the business year end to allow it to claim capital allowances in the current tax year? Or can you accelerate any purchases you're planning in the next few years to bring forward the tax relief? The main allowances here are the £1 million annual investment allowance and the full expensing scheme, which allows 100% first year allowances on qualifying capital expenditure. Practically, these allowances are normally more than sufficient for the clients that we service. Since the 1st of January 2026, companies have been able to claim 40% first year allowance on qualifying new and unused main rate plant and machinery. And from April 2026, for companies and unincorporated businesses, the main rate of writing down allowance will reduce from 18% to 14%. But as I say, for most of our clients, the 1 million annual investment allowance together with the full expensing covers any investment in assets that they are making. Finally, for this slide, we've covered quite a bit, is trivial benefits. Have you made use of trivial benefit allowances and the exemptions to provide a little perk to your employees? So as long as you ensure that these benefits are below £50 and comply with the relevant conditions, i.e. they are not cash, most of the, you can do a quick Google of trivial benefit exemptions. There's a couple of conditions to comply with, but there is a way that you can give a number of £50 vouchers to your staff, and complying with the relevant conditions, these will be tax-free. And again, for directors or office holders, there's trivial benefit allowances. There is a cap on these, which unlike the employee benefits, but the cap is £300 a year. So a real opportunity there to get, if you like, a little perk out of the company tax-free. We've covered quite a bit there, so I hope you're still with me. But Sam, just from your interactions with your clients over the last few months, what have the business owners you deal with been focusing on?
Thanks, Adam. I think I already mentioned it, but a lot of the conversations are very much around that salary dividend mix, whether that £12,570 director's salary alongside dividends is still the most tax efficient way of doing things. It's definitely worth revisiting rather than assuming everything's going to be the same. I mean, for example, someone with £100,000 of income, combined salary and dividend, would have nearly £2,000 of extra tax to pay. But there's a bigger picture you've got to think about the corporation tax impact. So yeah, there's been quite a bit of thought around that and a few conversations. As I said, a lot of those are ending up in actually it's still the best way, but definitely something to potentially visit. I think the other, well, this is really ongoing, always and forever for us as accountants. But clients thinking about corporation tax reduction, and then you've got your typical things like making pension contributions before the year end, thinking about whether or not you can bring forward any asset purchases, and just making sure that you're not leaving money on the table for some of the things that Adam's focused on in the last few minutes. We can always, if clients are really struggling to reduce their tax bill, we're always happy to increase our accountancy fee because that has a similar effect. I'll let you carry on, Adam.
Okay, thanks, Sam. So if you're unsure about any of the areas we've discussed, please feel free to reach out to myself and Sam, and we can discuss them further with you just to make sure that your business and yourself are fully prepared. So some other business tax changes in 2026. The key changes happening this year, all which could impact you and your business: the living wage and minimum wage increases from April, business asset disposal relief changes again from April, and some CGT and IHT changes, which we'll now look at in more detail. So the wages first. Any of you who employ staff will already be aware of this, but essentially, national minimum wage and the national living wage are increasing from April, and therefore your employment costs will rise. The table shows that the headline from the table is that the national living wage will increase by 50p to £12.71 an hour. And for 18 to 20-year-olds, there's an increase of 85p to £10.85 an hour. So as you can see from the table, percentage increases are really quite high. So as business owners, you'll have to accommodate this in your bookkeeping, your payroll, and your budgeting for the next year. The largest increases in the table are on the rates commonly used for young workers, 18 to 20, 16 to 17 apprentice rates. And there has been much talk about the effect on the jobs market for young people. Recent statistics showed nearly 1 million people aged 16 to 24 were NEETs, not in education, employment, or training. That's 12.8% of that age group. Clearly a huge issue. I think the Chancellor will be speaking in a week or two, giving a lecture, and it's expected that she's going to be focusing on opportunities for youngsters in the job market. It's really a big issue here and now, and obviously for the future of the country. So with regards to the wages changes, if you're doing your own payroll, or if we're doing your payroll, or you have somebody processing your payroll, they'll need to be careful to make sure that compliance is stuck to, and changes and reporting requirements are met. As you can see from the slide, there's some significant changes coming to business asset disposal relief, which everyone should be aware of. So from 6th of April, just three or 4 weeks away, the tax rate on gains eligible for business asset disposal relief will rise from 14% to 18%. It's important to note, however, that the £1 million lifetime limit remains unchanged. So what does it mean to you as a business owner? If you're planning to sell your business or its assets, this is going to directly impact you. Higher tax rates on disposals means you'll face a larger tax bill, which could reduce the returns you take home after a sale. So now's the time to think carefully about your plans. If you want to lock in a current lower rate, you might need to accelerate your disposal timeline or revisit your long-term exit strategy to account for the increased rates. We've recently been helping a number of clients who wanted to take advantage of the lower rate of BADR whilst it's still available. Taking action sooner rather than later could make a big difference to your financial outcome, but as I said, there's not much time left before the 6th of April. So whether or not you're going for a sale here and now to lock in these tax rates, have you reviewed your exit strategy, be it now or be it 5, 10 years down the line? If not, now could be this time to start planning. CGT and IHT. So for the 26-27 tax year, capital gains tax rates for most assets are set at 18% for basic rate taxpayers and 24% for higher rate or additional taxpayers. However, as I just said, the rate for BADR is increasing from 14% to 18%, and the annual CGT exempt amount remains at £3,000. AR and BR, or APR and BPR, agricultural relief and business relief. The budget in the end of 2025 announced some reforms to agricultural relief and business relief. And they've been messed around with a bit over the last few months. So the way it stands at the moment, the 2024 budget announced that assets that currently qualify for 100% relief for agricultural property or business relief would be reduced to 50% on values exceeding £1 million. After much lobbying from business and especially the Farmers Union and all the protests outside Parliament, just at the end of December 2025, it was announced that from 6th of April 2026, the proposed threshold will rise to 2.5 million per individual, and couples will now be able to pass on up to £5 million of agricultural or business assets between them, on top of the existing allowances such as a nil rate and residence nil rate band. That was a big change and impacted a lot of businesses. Obviously, it doesn't impact the very largest businesses, and some of the smaller businesses who were below the 1 million allowance were unaffected by the changes in the budget. But there was a lot of concern in the business community until those changes were announced at the tail end of December 2025. Just to note that AIM shares will see their business relief reduced from 100% to 50%. Okay, and in the latest budget, Rachel Reeves announced CGT relief on disposals to EOTs, so that's business owners disposing of their business to employee trusts will now stand at 50% instead of its previous 100%. So despite these changes, EOTs can still offer tax advantages, including tax-free bonuses of up to 3,600 per employee a year, and no inheritance tax implications for selling for the shareholders who are selling. But slight changes, but they are still an attractive route for possibility for people selling their businesses. Okay, so what to do next? As I said, we're very close to the new tax year, so this is what we'd recommend for you. Take your time to review your tax position, both for your business and personal finances. Identify where you stand at the moment and what actions might benefit you in the short time before the year ends. It's also essential to plan properly. Waiting until the very last minute could mean missing out on key allowances and reliefs or not being prepared for the impact of new regulations. Remember to take a step back and review your strategies. Whether it's payroll planning, your vehicle, or investment decisions, now's the time to adjust and ensure you're optimizing your tax efficiency. Finally, don't hesitate to reach out to us or as Sam mentioned at the beginning, possibly an IFA to seek professional advice. Speaking to a specialist can really highlight opportunities you might not be aware of and help you avoid common pitfalls, especially with the upcoming changes in 2026. Okay, I think now is an opportunity for some questions. We have had a couple of questions in, so let me just have a look at them. That's going back to the example I gave right at the beginning. Somebody's asked, we're a couple and everything's in my name. Is that a problem? Well, as we saw in that example, it's quite common that one half of a couple has potentially more assets, more income than the other. So it's very common. I would say from a tax perspective, it's often not the most efficient way of structuring things. There are opportunities to transfer assets between spouses exempt from CGT, and that can make a difference when selling the assets or the income from the assets. So whether it's, as Sam said, sharing the rental income or splitting the dividend income, it's really one of the most straightforward planning opportunities and well worth considering if there is a bit of a lopsided arrangement in your household. Sam, do you want to have a go at this question? You can see the second question. Do you want to have a go?
Yeah, okay. Actually, before I answer this, I'd just like to some of the slide timings weren't quite right there at the end. I have to hold my hands up and say I'm in control of the click-throughs, so I have to take the blame for that one. So this question. So I've never claimed gift aid on my donations. Can I go back and claim previous years? So yeah, it is an interesting one actually, more interesting than it might sound, potentially valuable as well. So I know we've already covered this idea that you can make a gift aid donation and carry back, but this is slightly different. This is actually going back and correcting where they've been missed, and it is actually definitely worth doing. You can go back 4 years. So if you have identified if you're a higher or additional rate taxpayer that you've made donations in the past 4 years and not claimed the tax relief on them, then it could really add up. It can be a really meaningful refund. So if anyone does have that situation, and obviously the person who's asked the question potentially does, let's pick up after the webinar, and it's something we can help with.
Okay, there's a final question which makes me realise now that we've missed a couple of things out. So the question was about MTD, and I'll just go through some of the information on MTD. Making tax digital is the government's intended plan to make all tax returns for VAT or income tax, corporation tax digital rather than paper-based. And the big change coming is that from April 2026, MTD for income tax starts and will affect people with self-employed income above £50,000. From April 27, it'll be people with income above 30,000, and April 2028, it's income above 20,000. So those entering MTD in April 2026 will need to submit their first quarterly update by the 7th of August, and your digital records must be accurate from the very start of the tax year. You'll still need to file your tax return, 25-26 self-assessment tax return, by January 2027. Those affected by MTD will need to keep digital records of your income and expense, use HMRC compatible software, submit quarterly updates to HMRC, and complete an end of year declaration. So we have been working with a number of our self-employed clients to make sure they're registered for MTD, and where appropriate, ensuring their solution, the appropriate solution is in place to ensure submissions are made. If you have any questions on this or require any specific advice or assistance, please do be in contact with us. Sam mentioned earlier that tax thresholds, personal tax thresholds, have been frozen till 2031. So that's causes an issue for all of us, really, due to fiscal drag. Another quick thing to look at is salary sacrifice caps. At the moment, pension contributions made through salary sacrifice are exempt from income tax, national insurance for employees and employers, and it was a valuable way to increase pension savings and reduce costs. It's been announced that from April 2029, there'll be some changes, and there'll be a £2,000 annual cap on national insurance savings from pension contributions. Other salary sacrifice opportunities, such as for ultra-low emission vehicles and cycle to work schemes, still exist, and there are some savings there. I did read in the last few days that the House of Lords is discussing this bill at the moment and has introduced an amendment to raise the cap from £2,000 to £5,000. So we'll just have to keep a track of where this actually ends up and what eventually is passed by the Commons as law. But there are potentially some caps coming in on salary sacrifice. And again, something Sam mentioned earlier about corporation tax penalties doubling from April 2026. There's going to be a first substantial increase in corporation tax late filing penalties for over 25 years. So a late return will now trigger an immediate £200 fine, up from £100. If it's more than 3 months late, it'll now be a £400 fine rather than a £200 fine. And if you're a repeat offender, these fines are doubles. So a £1,000, what was previously a £1,000 fine, could be a £2,000 fine for prolonged delays. Obviously, these apply to even dormant companies or companies with no tax liability. So being on top of your company affairs and making sure your records, etc., are up to date to allow the accounts and tax return to be filed on time are important, always important for compliance. But with increased penalties, then the incentive is a bit more increased. So there was a question about MTD, but we've just covered that at the depth. And the question was, with the changes in making tax digital, do we expect, how worried should we be about HMRC inquiries increasing with MTD making tax digital? I think what we've seen and read about this is that it doesn't necessarily mean that the chance of a random inquiry will increase. What it does mean is that HMRC will have more data on a regular basis. So the chance for HMRC to look at more data-driven compliance and anomalies coming out of the data that they have, so being able to see inconsistencies or compare the data being submitted through MTD with data from other sources, that might increase the opportunity for HMRC to open specific inquiries when they have concerns. But if you're doing everything correctly and keeping up to date with your records and not taking advantage of possible weaknesses in or perceived weaknesses in HMRC's inquiries and HMRC's oversight, then there really is nothing to worry about there. So thank you for joining us today. And remember, if you'd like any help with your tax planning, or you need more information on what we've discussed today, we'd be more than happy to speak to you. Just give us a call on our number, which is on the slide. Give us an email or reach out directly to myself or Sam. Thank you very much for listening, and we hope to speak to you soon.